What's up, guys? So excited to be here again. Glad you guys are tuned in for another episode of Money Talks. God bless you all. It's a blessing just to be here. The name of this episode is all about debt. All about debt. So this is a very great topic because I know a lot of people deal with debt in their lives, and I feel like I have some very, very valuable information to share, very valuable information to get across to you guys. So let's dive right in. Let's get on started. So debt, yes. Is debt good or bad? That's always been a question. Is it good to have debt, or is it bad to have debt? A lot of experts have spoken on debt, and that has been a great, serious question, whether debt is good or bad, in our lives. So what is debt though? So debt is basically like I would say a financial obligation that, requires you as a debtor, the party, to pay something, money that you borrowed or otherwise have been withheld from another party, which would be, in this terms, the creditor. So the definition is basically a financial obligation that you have to pay back from the creditor that they have lent to you or you have borrowed from them. And debt is actually used by many individuals, individuals and companies, and large companies, small companies, any type of company, to make large purchases that they couldn't, they wouldn't or couldn't normally afford under other circumstances. So, and however, it does have to be paid back unless it becomes forgiven by the lender, or whoever's lending the money to you decides to give you forgiveness, and that's where it doesn't, that's the only circumstance I would say where it doesn't have to be paid back. So, and there's usually interest applied to debt. A lot of interest could be applied to certain debt, and small interest could be applied to certain debt. Some great examples of debt that you guys may be very familiar with is student loans. Student loans is one type of debt where students take out federal student loans to pay for college, and unfortunately, it can end up being a great sum of money that you will have to pay back. Another big one, and this is often probably the largest type of debt aside from student loans, I would say, in my opinion, is mortgage. Taking out mortgages, a mortgage on a house, a mortgage on a business, a mortgage on an establishment, or any sort of thing like that. But mortgage is usually one of the largest debts as well that you will have as well. So, debt, is that good? If that good or bad, I would leave that in the hands of the beholder, in the eyes of the beholder. Whoever, everyone may have their own opinion when it comes to debt being good or bad. So I wouldn't personally give a answer to that question. I think that answer is gonna vary depending on who you ask. So yeah. My next point I want to go into is leveraging debt. How do we leverage debt? Can we leverage debt? So yeah. You actually can leverage debt in a way that's beneficial to you. So a lot of lenders go by your debt to income ratio, and that is basically a percentage that the company basically compiles and compares your total debt payments to your gross income. So it's a percentage that compares your total debt to your gross income, and it's usually expressed on a monthly or annual basis. So how do I know my debt to income ratio? I'll tell you. So basically, to get your debt to income ratio, what you want to do is you want to get all of your monthly debt payments. You want to write down a list, and you want to divide those monthly debt payments by your gross monthly income. Now, gross monthly income could be another, subject where we may not know how to calculate it. So in order to calculate your gross monthly income, what you would do is two different ways. If you're a salaried earner at a 9-to-5, or you're an hourly earner at a 9-to-5, what you would do is, for salary workers, you would take your total annual salary and you would basically divide that by 12 months in a year, and that will give you your gross monthly income. And then if you're an hourly earner, I would say you would take your hourly pay and you would multiply that actually by the hours that you've worked, and you would then multiply that by the 52 weeks in a year, and take that answer that you get and divide that by 12 months. That will give you your DTI, or debt to income ratio, for hourly workers and salary workers. So basically, why I say that is because lenders, they tend to use this as one of the reasons, one of the things, one of the checklists they use on their checklist. This is one of the points that they go for. They use your DTI to basically measure your ability to manage those monthly payments to repay the money that you plan to borrow from the company or the lender, in other words. So whatever your amount that you're trying to get from that lender, they're going to look at a number of factors, but this DTI, debt to income ratio, is going to be a major factor that they're going to look at. And it depends on whatever lender you're trying to go to. It could be a make or break for you acquiring that credit or acquiring that loan that you're trying to get. So different loan products, basically they have different DTI limits. So depending on the type of loan and, like I say, the type of company that you choose to go to, there are going to be a lot of different loan limits, DTI, debt to income ratio limits. So it's important to have a greater understanding of what your debt to income ratio is, and how to manage it and how to leverage it in order to leverage debt in your personal lives. So that's a great reason for a great example, and a gem that I want to throw out there for you guys to be able to understand a little more about how to leverage your debt. Debt consolidation is a greater way to, it could take a hike on your credit score at first, but consolidating your debt does play a great purpose in reducing your debt and ultimately getting to no debt. What debt consolidation is basically taking all of that debt that you have on a specific place, and it's consolidating it into one debt, usually with lower interest payments or a lower amount, so that you can to help you out in a sense, or a manner. I feel like there's different types of debt. There's a lot of debt that can be acquired. There's loans, there's lines of credit, there's credit card debt. Their debt falls into either secured debt or unsecured debt. Those are the main two types of debt. And it's a greater sense of understanding what a secured debt is versus what an unsecured debt is, and there's a lot of great videos out there that can elaborate or go into greater detail on that, and it speaks on it, and helping out with you and your credit, which we're going to talk about on the next episode, all about credit. We'll dive into credit on the next episode. I don't want to go too deep into that right now, but basically, yeah, that's how you leverage your debt, and that'll be a great way to, a great checklist to go about when you're trying to leverage your debt. I also can tell you, when you're paying off your debt, there's a specific way that you kind of want to tackle this or go about this. And I would say, first, what you want to do is you want to include debt as an expense in your monthly budget. If you don't have a monthly budget or a yearly budget, you might want to, start creating one to help you be able to budget better or more accurately track your funds and where your money is going. Because if you don't know where your money is going, that can lead to a lot of problems as well. So, first thing you want to do is you want to include that debt as an expense in your monthly or yearly budget. So you want to create a debt list and list out all your debts, list out every debt that you have. Your credit report is a great way to find all of your debts if you don't know all of them specifically. You want to go ahead and look on your credit report, list out your debts, include that as an expense when you're budgeting. Recreate your budget list. So, and after you do that, you want to devote a greater portion of your income to go specifically to those monthly debt payments. So I spoke about the 50-40-10 rule in one of my previous episodes, and what you want to do is you want to rearrange your 50-40-10 rule if you're trying to devote a greater portion of your income to that debt to be able to discuss it. And this is only for the people that's trying to leverage their debt or decrease their debt or get to a point where they have no debt. So I'll discuss that more when I'm talking about credit in my credit episode. After that, you want to pay off, and you want to prioritize your highest debts, and you want to prioritize the ones with the highest interest rates first. So you want to work your way down after that from your prioritizing your highest and your most significant debt to your lowest until all your debt is cleared. Once you've mastered and accumulated this type of strategy to reduce your debt and pay off your debt, congratulations. you're on your way to becoming debt free, and you're on your way to opening the door to many new possibilities in a completely different life where you can have greater opportunities to meet with lenders that are willing to give you money. There's a lot of banks that may be hesitant on giving you money because of the debt that you have, or your debt to income ratio, but there's also a lot of banks that are way more willing to give you credit card limits, give you credit card lines of credit, give you things like loans and houses, business loans, things like that, house loans, when you know that you're going to be a good customer. So it's all about consumer law and all things like that. I won't touch too deep on that, but mostly what you want to do is get to a point where at least you have about less than 5K in debt. And I think if you work hard at it, if you really go on what the strategy that I gave you and you really tackle that, it's a greater chance that you can reach to what you're trying to reach and get to the point that you're trying to reach and reach that goal of no debt, being debt free. Once you're debt free, the possibilities are endless when it comes to money and money talks, So all about that. I don't want to go too long, go too much over my time. I know that's all the time I have for today on this episode. Make sure you tune in next week. Next week, we're going to drop an episode all about credit. We're going to touch on every point, every basis where you can learn how to leverage and increase your credit score, things you can do to get hard, increase off your credit, things like that, all types of things. We're going to just go all the way into it. We're going to dive right in. And I'm glad you guys are here listening in. I hope you guys tune in next week. Don't forget about our next episode, Monday. Episodes drop every Monday. God bless you all. Thank you all for being here. I pray God bless you all with the opportunity to be able to leverage your debt, to be able to decrease your debt and become debt free. I pray God give you the strategy and the concepts and the knowledge and the wisdom to be able to go about leveraging and understanding debt and what debt is. I hope this episode helped. Tune in next week. Be sure to catch us. Money Talks, Smart Money Listens. Tori, I'm out.